Hello there. This is Virtual Nexus and Crypto Diaries, and here we are going to go over some blockchain and cryptocurrency today, or cryptos as I like to call them, because they're not all currencies. All right. Cryptocurrencies and blockchain investments are extremely speculative and risky. They fall outside of much of the current regulatory frameworks and as such are risky for novice and experienced investors. Because of its novel nature, the cryptocurrency market is fraught with many difficult to evaluate assets, including fraud, scams, and schemes. Do not risk anything you cannot stand to lose. Furthermore, intensive due diligence surrounding complex technical, financial, and regulatory issues is required in this market. This presentation and all associated with Crypto Diaries and Virtual Nexus are for educational purposes only. We never recommend the purchase, sale, nor trading of any specific asset or issue. However, we do offer information to enable our audience to learn how to manage their own risk and potentially capitalize on mispricing in the cryptocurrency and blockchain market. All right. So yesterday we talked about, well, not yesterday, in the last section, which was section 4 of our blockchain fundamentals, we talked about essentially Bitcoin. Okay, let's go over here. And we talked about transaction fees of Ethereum, transaction fees of Bitcoin, which is 1/5, so ETH does 5 times the transaction fees. We talked about the halvening schedule, which shows that somewhere around, let me make this a little smaller here. All right, somewhere around 2040 or 26 years from now, 27 technically, we're counting from the next halvening, which is in March. Let's say half the emissions rate of Bitcoin. It's going to be issuing 5% of a Bitcoin, which means transaction fees have to go up precipitously. So something else I wanted to show you is a quote which I found in our last class. See if I can find this CoinDesk article, which was pretty amazing. Let's do our CoinDesk. Let's do our history. It's today. Come on now. Oh wait, I know how we can do this. Oh, my poor computer. Come on, buddy. You can do it. Oh, no. All right, let's go here. This is my Safari acting weird. We're going to go recently closed tab, and we're going to find countdown, having countdown. Here we go. Is this it? That is it. So we're going to find Satoshi's quote here from the anonymous Satoshi is, all right. All right, here it is. It is impossible to predict. Wait. In 20 years, here goes. I'm sure that in 20 years, there will be large transaction volume or no volume. Okay? That's right. Because eventually, right here, as Dubrovsky said, this cannot really work without very expensive transaction costs because Bitcoin cannot process huge quantities of transactions on chain. All right, so that's the issue. I don't think this halving will make Bitcoin significantly less secure, but in 8 to 12 years, we could find ourselves in hot water. What is the halvening? Once again, halvening is, okay, basically when the fee from each block gets cut down to a precipitous amount. Right now, it's at about 6.25, or right about here, 6.25, and then it's going to drop. So it's the inflation rate here is 4%. Anyway, it's going to drop. All right, we're right here. All right, 1 point. What did I show you? Our moneyprinter.info. It's at 1.85% today. That means that the Bitcoin supply grows by 1.85% every year. Now I pulled up CoinGecko, and so that means this year, all right, the total amount issued are there. We multiply that times 1.5, okay, times 1.85. It comes out as, wait a minute. There we go. 35,000 Bitcoin being issued this year. ETH is deflationary. However, ETH has way more tokens out there. Okay. ETH has about 120 million out there. But remember, ETH's fees get burned for gas. So let's talk about that now. We're now going to talk about essentially blockchain fundamentals, consensus. We're going to talk about the trilemma, what that is: tokens, currencies, smart contracts, and Ethereum. As an example, there are many other platforms. Okay, blockchain by consensus. Proof of work is where they solve a math problem, right? They have those expensive chips called application-specific integrated circuits, or ASICs, special chips designed for Bitcoin mining. Originally, Ethereum was proof of work. They switched to proof of stake last year to cut electricity consumption by 99.9%. I think it's at least 99%. All right. Bitcoin burns a boatload of energy to, quote, secure the network. What that means is it's solving that math problem. That's the security, how difficult that is. It's very expensive. Proof of stake uses a fixed amount of tokens, 32 currently for Ethereum, and 32 at roughly $1,800 is 57,600, though you can do that by half, 28,800, and there's soon going to be 8 tokens or $14,400. They earn yield. They get paid. In proof of work, you get paid inflation in tokens, so Bitcoin, Litecoin, and Bitcoin Cash, all right, all use proof of work. Ethereum used to, it's now proof of stake, so it pays a yield based on how much people are willing to bid for it. It's roughly 4% right now, the yield on Ethereum, which meets essentially the inflation, roughly the inflation rate. I'm not going to, interest rates. We used to think that 5% was the natural interest rate for an economy. We're not going to get into that, but we're going to go into stakingrewards.info to look at the yield of some common coins. ETH pulling 4.48, Cardano 12 point, like a tiny amount, Solana a tiny amount. So let's do the highest rewards. Yearn Finance 660%. Yeah, that's not really what it's hitting. We'll get to that some other time. Most of these chains you've never even heard. EOS is like a ghost chain that uses delegated proof of stake, DPoS. We'll talk about that some other time. All right, Polygon's pulling 4.78. Let's Avalanche pulling 3. Polkadot pulling 6. Tron pulling 1.76. I think they filed charges against Justin Sun, which is probably nonsense, but we'll have to look at them later. Cosmos Hub 7.5%. That's pretty good. That's Atom. We'll talk about Atom and Polkadot at some point. Let's keep those in charts. Cosmos and Polkadot matter. ICP as well. Even though ICP is going down, it is a revolutionary token, which we will discuss. So what am I trying to say here? All right, it costs money to run a blockchain, and it's the same thing as paying your entire banking system. It's arguably a lot cheaper, percentage-wise. Why? Well, it's for example, it costs the same amount to send $1 million on a blockchain as it does to send $1. That's why. There's no increased rate for all of that. All right, and then once it's up and running, so just imagine companies that spend millions of dollars on transaction fees, that's going to go down by like 1 million times. They'll be paying like, if they pay billions, it'll be thousands of dollars. All right, let's go. The blockchain trilemma is security, scalability, and decentralization. What does that mean? Security, okay, means that how much it costs to basically be sure that it's hard to attack. That's going to be expensive. Versus scalability, how fast it's going to move. Versus decentralization, how many nodes are out there. So these three things act against each other. So we got, these are some different tokens. IOTA, that's what I was saying about directed acyclic graph we'll talk about. So we got EOS, Ripple. These ones are all relatively centralized. They're less decentralized. ETH used to be more decentralized than Bitcoin or equally decentralized. Now there's arguments around that. We're not going to get into those right now. It's mostly a red herring. I mean, there's 3 major mining pools in Bitcoin where the independent nodes must join to get a chance to earn rewards, because a mining pool divides up that math problem, right? So more miners can work on it at the same time. But then it also divides up the reward between all the members of the pool. ETH used to have pools like that. Now they're validators, which we'll talk about some other time. So security versus scalability. So the most secure and the fastest are going to be relatively centralized. The most decentralized are going to be slower and less secure. So somewhere we want to be around here usually. All right. Blockchains and tokens. This, again, most of my graphics are from Block Geeks. They just say that you have to reference them. So there's your link down there. So they have smart contracts. We got Internet of Things. That's what IOTA is. That's the little, like the devices in your house, consensus coming to a decision independently of you. Identity management. What else in here? We got storage like Filecoin down here. And then they're putting real estate on the blockchain. But these aren't really individual tokens yet. But we have lending, Aave, so like yield farming, Yearn, exchange, and many more. All right. The currencies, main ones, they have a monetary policy. Bitcoin's 21 million. That's their policy. The rest of them have some form of inflationary policy due to the fact that as the economy grows, you want more money. This is the challenge that people have. In a single commodity economy like gold, the price of gold just continually goes up. Nobody uses it. The velocity of money slows down, and your economy comes to a standstill. All right, these are the things that you want to think about. All right, digital scarcity. We talked about how the blockchains, the tokens are emitted on chain. They stay on chain forever. You can move them around on chain. They now have the ability to bridge them to different chains, which we're going to talk about today. Let's see. We got deflation. ETH burns tokens because it's used as gas. Now, people say the monetary policy in Bitcoin is fixed. It's not true. All right. I'll give you an example. One time they found a bug that you could emit infinite Bitcoin. All the block guys voted. They changed it. When I say voted, it means that all the blockchain devs or Bitcoin devs, there's not that many of them, all decided to fork the chain to remove that. So it can be changed, and I would argue it will be changed, because once the transaction fees in Bitcoin become astronomical, people will want to increase the tokens. Not only that, there's like 1 million tokens locked up, lost here and there. Now, Monero has an inflationary policy. Let's look up Monero's inflationary policy. Try this. XMR, Monero, inflation. Okay, inflation will be 1% in 22 and go down forever, but the nominal inflation will stay at 0.3 of an XMR per minute. That matters. That means it will pay people to mine it. All right. Monero is the best coin out there. It's a privacy coin. Don't let me get started. When I say best, I mean that's opinion. That's not a fact. Okay. But I find XMR to have a great story. Now, governments will probably outlaw it because it's a privacy coin, but really, that's the only coin one really ought to use, because what you're buying is none of anybody's business. We use terrorism and finance to basically track everybody. This is a bad thing. They implemented these finance rules like suspicious action reports, SARS, and all this, with the FATFA, Financial Action Task Force, whatever it is, for crimes, and they rolled this out right after we moved off of the gold standard. I'm sure it's a coincidence. It's like 74. All right, let's continue. So these are the currencies: Bitcoin, ETH, Monero. Zcash is solid. It has privacy in it. It's one of the most used in Latin America. And then Dash. All right, smart contracts. That's code that's written and committed to the blockchain. Okay, it's publicly available on Ledger. When an event outlined in the contract is triggered, like an expiration date or asset target price, the code execute. You can watch this activity on blockchain and understand the market while still maintaining the privacy of individual actors. Oh, what was I just talking about? Okay, these are the smart contract platforms. Actually, that's not true. XMR is not in there. I got to update this. So ETH, Solana, Cardano. Yeah, those are the only 3 main ones. Let me fix that. I'll fix that later. All right, that's a general idea. All right, Ethereum, we're going to talk about smart contracts. Let's do some. Should we run a smart contract right now? I don't think we're going to run today. We're going to summarize what we talked about, and I'm going to close this off. Essentially, what we talked about today, we talked about blockchain 1.0, which is grandpa chain, boomer coin. Bitcoin, that is the one that only has currency and transactions. Although they're adding what are called ordinals or NFTs. Unknown fact, largely unknown fact, the first NFT was written on what? Nope, not Ethereum. It was written on Bitcoin. Never forget it. All right, so they're adding that, and a lot of Bitcoin, Bitcoin, not classicists, but Bitcoiners are like, oh, you're bloating the blockchain. It's going to have to compete. It's why I actually moved to Bitcoin, in 2015. Moved from Bitcoin to Ethereum. I guess 2016. I went to the DevCon in 2017. I moved from ETH about a year before that, maybe a year or two, maybe end of November 2016. Could have been a year before that. I'm thinking 2015, but I don't remember. It's been a while. So that's blockchain 2.0 as the smart contracts, it's Ethereum and Cardano and things like that. And what I call blockchain 3.0 is a blockchain of blockchains, which is Polkadot and Cosmos, for example. Listen, I love you all, and I wish you the best. We will talk soon. This was number 5. Okay, so this is Blockchain Fundamentals 5, and we're going to talk more about smart contracts and what those mean most likely in our next talk. I'm trying to get to layer 2. I'm trying to get there. I'm trying to show you the environment so you can start utilizing this wonderful and amazing new technology that liberates and reduces friction. It's an economic miracle and technological miracle. God bless you all. Out.